From New York City for viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrow. Stocks are managing to eke out a bid this morning, but small business optimism is at an 11-year low, and this the Fed should pay attention to. So says Mohammed El-Arian. We'll count you down to the open. It kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up on the show, markets on edge ahead of another big inflation report. Former Fed President Jim Bullard makes the case for 3 rate cuts. And oil prices around a 5-month high as geopolitical tensions simmer. We begin with the big issue. It is the great rate debate, and it's heating up.
I look at the beginning of the year, which isn't that far, that many months ago, we were looking at 3, 4, even 5 cuts. So I think that the market is still uncertain. What does that say to me, though? It says that we have flexibility, and that's such a great thing. Look at Jamie Dimon's letter, which came out. He's looking at what? The market's saying 70%, 80% chance of a soft landing. Well, what if we're wrong? We have tools here. We have the ability to cut rates and stimulate the economy if we see those signs of weakness.
We have the ability. The powder is dry. Let's discuss. Invesco's Matt Brill and Patrick Fruzzetti join me from Rose Advisors. Good to have you both with us. So here we are. We just had that conversation this morning about the flexibility. There is debate within the Fed. There's flexibility to respond if things slow down and unemployment rises. But my question to you both is, as Bullard reinforces the case, he doesn't vote anymore, he's not part of the Fed, but 3 cuts is what he would be doing. Are 3 cuts an insurance premium that we need in this market, Patrick, to ensure the Goldilocks soft landing? Good morning.
Good morning. I don't know if it requires 3 cuts. I think we're a data-driven market. We'll have, obviously, our CPI figures come out on Wednesday. I do think that the labor participation rate ticking up by a little bit last week does leave, a June cut still on the table. But, I don't know. I think, it's going to be a data-driven market. And obviously the result will be, if there aren't as many rate cuts, I think we'll see a lot more volatility in the stock market.
Are we ready for that volatility? I mean, we haven't seen a drawdown of more than 2%. Matt, good morning to you. We haven't seen a drawdown of more than 2% in this market. We haven't seen virulent reaction to this bond market. It's trading up at 4.5%. Should we prepare for and spend money on volatility, whether that's bond vol, equity vol, or cross-asset vol?
Well, I think at this point, the economy continues to be just incredibly resilient. You could say it's as strong as UConn and USC's basketball teams. And so it just keeps going and keeps going. But at some point, yes, we will have some volatility here. We're going to have, some hiccups, whether it's on the growth side or on the inflationary side, it's yet to be determined. But vol has been low. But one of our main themes for this year has been that we will go back to normal, that we don't have to have these extreme levels of volatility that you've had from basically the start of the pandemic. So, yes, volatility may pick up a little bit, but to the extremes, we don't think so. So we'd be big sellers of vol if it were to increase from here going forward.
Okay, there you go. Let's see who would be the buyers and the riders of vol in this environment. Look, we're bracing for CPI, so let's get ready for that. Mike McKee joins me to set the table. We're looking for a dip on the core, but the year-on-year, Mike, can't be ignored.
Yeah, it's kind of an interesting situation because we get into base effects, so we're going to see a difference between the year-on-year and month-on-month and the way they go forward. At least that's the theory behind the consensus estimate of economists that we surveyed. The headline numbers are both, and the core numbers, both supposed to go down on a month-over-month basis by a tick. Headline year-over-year, though, would rise. That's largely because energy prices have gone up. The core on a year-over-year basis goes down. Now, of course, progress is what the Fed is looking for. Will we see continued progress? You got to take it apart. I want to show you 2 things here. One, all the way over on the right-hand side, goods deflation was behind the fall in CPI. But look what happened last month. It went up a little bit. Now, is it going to continue going up? Have we seen the end of goods disinflation? And as you can see there, last month we had a little bit of a rise in services inflation. What happens with that? That's something to watch. Also, check out the y-axis there on the right-hand side. I was talking with Mohammed El-Arian this morning about this. We are now down to parsing three-digit changes in the CPI. That's how close we are to the, I guess, target, or close we are to how various economists are thinking about it. And one more thing that we have to look at tomorrow is going to be housing, because that's been the biggest problem for the Fed. And you can see here in our ECAN function that the owner's equivalent rent has come down, but it is still a major contributor to CPI overall. Rent of residence still a major contributor to CPI overall. So at this point, that's what everybody's waiting for. Do we get a bigger drop as we go forward, and does that finally start to pull down that core CPI?
Okay, well, all eyes down for that. And why be a hero taking risk in the next 24 hours? My guests this morning are Matt Brill and Patrick Fruzzetti on these markets. Patrick, listening to Mike, listening to the agenda in terms of CPI, do you think, Mohammed, I mean, we had the small business survey this morning. Mohammed El-Arian makes the point, the Fed should be listening to that a lot more acutely than they are to nickel and diming over the CPI.
Yeah, I think that's fair. But, you know, I just look at some other indicators. I mean, just look at what has happened with commodities. And it's across a lot of different commodities, precious metals, obviously in the energy market. And I think that that is signaling something. That is signaling that if the Fed does cut based on where inflation is today, that they are basically saying that they're accepting more inflation. And so I think that is an indication of what's going on. Granted, the economy's healthy. There's a lot of, buying in Asia of precious metals and copper. But I think that that's an indicator. And so, again, if they do follow through with some rate cuts, it may be short-term stimulative. But overall, we're just focusing on having a balanced portfolio, both fixed income and equities, and not following the momentum trade in the equity side of the equation.
Do you think we run the risk, again, a lot of stories have been written recently about momentum fading. The risk is that momentum fades. It's been a huge driver in this first 3 months of the year. Do you think that that is a key risk at the moment as we turn over into the earnings season?
I definitely do, because, I don't think it's going to take a lot to roll over on some of these momentum trades. And so, again, if you have the opportunity to rebalance your portfolio at this point, you should do it. And I think, you're still kind of getting paid to wait, with where, money market rates are and bond yields are. So I think it's fair to make some adjustments at this point in the year going into earnings season. The momentum trade, I think, has just gotten way too hot at this point.
It's interesting because, of course, those money market funds, people who were maybe going to pull the trigger towards the back end of the first quarter, it's now extend and pretend for those. I was drawn to what Wells Fargo had to talk about this morning with me a little bit earlier. They're talking about secular optimism, and this is what they had to say. In our view, the bull market, AI's secular growth story, and index concentration have shifted investors' attention away from traditional valuation measures and towards longer-term growth and discounting measures. And I suppose the question here is the valuation threshold seems to have decreased, and the time horizons have increased, and that's the point that they make. Do you think we're slightly over our skis in terms of the models that we're using?
Well, yes, because when you look at discount rates, discount rates today should be higher. But they're still using, they're basing it on expectation that the discount rate will go down. And in many cases, I think they're expecting the discount rate to go down significantly. And if that were to be the case, then maybe, some of these current models will work. But that is, we're sort of old school when it comes to valuation metrics. It's math. So, we tend to side, on the mathematical, factual based part of part of valuation. So, none of that has changed. And there are still pockets of the market that are very interesting. Certainly, if you're focused more on the value side of the equation, away from momentum, I think there's some very, very interesting companies out there that you can invest in today. And like I said, in the fixed income space, you can balance out your portfolio with some fairly attractive yields still.
Matt, let's go back to where I started, which was you are a believer in the year of the bond. And my question to you was very simple. We've had so many false starts in this call, not just your call, but many people's call. What is it that makes you believe we're still going to have the year of the bond? We're down 2% at the moment. Real money, in theory, is supposed to come in. So what is it that really ignites the year of the bond?
Yeah, good to be back on here. So, I think what's eventually going to happen, and this is what we saw last year, right? We lagged all year long. We lagged cash, and then we came through in the fourth quarter and ended up 7-8% for the bond market. I think it's entirely similar, or possible to see a similar thing that happens this year. And when you have a coupon of 5.5%, which is where the investment grade market is currently trading, as Patrick was saying, there's math behind all this. Math starts to help you at a certain point. And the bond math tells you that if you go 100 basis points tighter, you're up double digits. If you go 100 basis points, wider or higher, you're basically flat. We think that you'll be lower in all-in yields, and by the end of the year, you will be in high single digits. So at some point, the bumpy road of inflation will start to prove to be a little bit more linear. At some point, the economy will start to slow just enough to see a few cracks out there. And we have a Fed that is wanting to cut. Yeah. They just want any sign that there's any sort of slowdown in the market, and they will cut. And when that happens, you'll start to get really positive total returns.
As soon as that window opens just half an inch, they'll be in like Flint. Matt, thank you very much. Matt Brill, good to have you back. Sorry for the interruptions on sound to you and to our viewers. Patrick Fruzzetti, my guest this morning on the markets. Let's look under the hood ahead of the opening bell. Abby's with me. Abby.
Well, we do have some stocks moving in a big way. One of them is Tilray. The marijuana stock is plunging down about 15% in the pre-market. This after they cut the full year guidance and the third quarter net revenue miss. So a big decline there for that stock. Delta Airlines up about 0.4%. They report earnings tomorrow. Analysts are relatively positive. In fact, we even have Susquehanna raising their price target to $54 per share, suggesting some nice upside potential could be ahead. And then AT&T heading to a fourth down day in a row in the pre-market, down about 1.5%. If that loss holds, this stock, Manus, will have lost more than 3.5% over the last 4 days. They will be reporting earnings in about 2 weeks.
Okay, pretty brutal run for them. Abby, thank you very much. Coming up on the show, Israel optimistic on ceasefire talks.
The question for Israel is what they are going to do, how and when they are going to go into Rafah. Right now, as I had mentioned, the ceasefire talks are really very close, and there is a huge amount of international pressure, including from the White House.
That conversation to come right ahead on Bloomberg.
Out of the 24 battalions of Hamas's military have been dismantled, and the 4 that remain are in Rafah. So the question for Israel is what they are going to do, how and when they are going to go into Rafah. Right now, as I had mentioned, the ceasefire talks are really very close, and there is a huge amount of international pressure, including from the White House.
Let's judge that optimism about a ceasefire and talks coming from Israeli officials. The foreign minister says this: we've reached a critical point. If matters work out, a large number of hostages will return home, and then in stages, everyone. And I'm optimistic. I'm more optimistic than I was. This coming as Hamas has said there's been no progress on the talks. Amri Hordern is with me now. Amri, how much of this is internal Israeli moment of shifting, and how much of it is pressure brought to bear by Lord Cameron and by the American administration?
Well, there's a ton of pressure, international pressure, that is weighing on the Israeli government. And then it's a great point. There's some domestic issues as well, some of those even more put to the right of Netanyahu that he is dealing with at the moment. What we saw is the defense minister talk about that these individuals, members of the IDF, that were being withdrawn from Khan Yunis, the defense minister saying so they can prepare for an eventual invasion of Rafah. Over the weekend, though, we heard from one Democratic senator, Senator Chris Coons of Delaware, is very close to the administration, talking about the fact that potentially this is a tactical movement because they have to redirect potentially some troops if there's going to be some skirmishes with Hezbollah on their northern border. And then, of course, you have an administration who likes things to take the view that the reason why you did see some of this withdrawal is actually because of the pressure the U.S. is putting on Israel. But the headline for me yesterday was Netanyahu said he has a date for when he plans to go into Rafah.
And in terms of the next steps for these negotiations, Anne-Marie, when you have Hamas coming down so hard on a negative side, what is it that we understand in Egypt will shift the dial?
It's a great question because Hamas said yesterday that they do not see progress in the talks and that there was no deal on the table. Yet we do see that pressure really from the United States. They had sent Bill Burns over the weekend to these talks. They would like to see a hostage deal and negotiation. There's still a lot of pressure from these families as well on Benjamin Netanyahu. The Israelis say progress has been made, but when Hamas says no, it feels like we're here once again, Manus, at a standstill.
Okay, Anne-Marie, we will track that. Anne-Marie Horder tracking the geopolitical situation between Israel, Hamas, and the rest of the world. Now, the world's largest independent oil trader says they've elevated crude prices for the rest of the year. Vitol sees prices anywhere between $80 and $100 thanks to strong demand growth. Goldman also step in. They have a similar call on Sunday. Joining me now is Alex Steele on set to discuss this. So I knew it wasn't going to be too long before we get a Goldman Sachs note in my inbox about $100 oil. Now, that's not their base case scenario. Yes. But this is a constricting market with rising demand and supply outages. So the confluence is to the higher level.
Yep, and JP Morgan beat them to it. They had their not base case, but also potential bullish upside.
They're all just too frightened to put their base cases in.
It's true. But there are a couple things that could stand in the way of that. One, you get price destruction if you wind up having prices go too high, and clearly the Saudis are going to be really in tune with that. You also had JP Morgan in particular noting $4 gasoline here in the U.S. would definitely cut demand by upwards of, say, 200,000 barrels of oil a day. You also have it elsewhere, too, like diesel prices in Europe, for example. There could be the SPR release, that famous, wonderful SPR release thing, but you need more acts of Congress to release more than would be actually beneficial to the overall market, and demand might not make it. I mean, demand might peter out.
So let's just pivot then to, who profits from. I love commodity markets. It's where I started. And if you look at BP's numbers, and you look at Vitol's trading. Can you imagine being on the receiving end of the bonus out there in Vitol? So just talk us through the scale. I'm just thinking about the bonuses, but you take me through the more important lines about the revenue.
I think the bonuses are totally legit. So this was the article that came out, is that Vitol, Trafigura, and Mercuria and Gunvor, so they're the really big independent traders, have a combined net profit of more than $50 billion in the past 2 years. If you compare that to 2018 to 2019, you're looking at just $6.8 billion. That's an enormous amount of profit. And that also helps BP. They had a trading update today where it should be relatively in line and strong oil and gas trading unit. And you also have these guys getting into other stuff like power markets, metals. Vitol's going to go back into the metal market. They confirmed that. It'll be a small part of their business, but they did wind up confirming it. Freight, they're also adding gas. A lot of other traders adding gas if they didn't have it. And I got to say, talking my own book, but that's all an energy transition thing. Like, you need all of this stuff if we're going to electrify everything and decarbonize everything. And that's what these traders are really going to get into.
But then this is also about where we're going to have a carbon credits market. This is part of the ESG. This is part of COP. So it is about the evolution of these markets. We've always had power markets. We've always had carbon markets. But it's about the next transition of these markets, the next evolution of these markets.
Well, and it's also these guys getting into those markets in a more meaningful way. And then in how they're going to wind up structuring that, particularly when it comes to power. Just power here in the U.S., we haven't seen power growth in like 20 years. And now power demand is going to skyrocket. And it is the data center and it is the AI, but it's also just regular people, too. So it's a combination of all of that. It's just like off to the races.
And this goes back, there was an oil company, shall remain nameless, which was here with me visiting, and they were making the point, the power usage in the United States relative to that in Europe. They see an exponential growth potential in Europe relative to the US, which is already, as you say, shifting into a higher gear. Great work. To be a trader at Vitol. Russell, pay them generously. Russell Hardy's the CEO there. Alex Steele on the energy markets. Coming up, you have your morning calls a little bit later. Schwab's Ann Sonders joins me around the opening bell, making the case for more volatility in markets. The conversation to come in just a moment on Bloomberg. We're skating on the edge of a bid as we go towards the CPI for tomorrow. Bond markets have taken a small breather. That gives these equity markets just a moment of relief. Nasdaq up 0.5%, but there's no standout stock that can define the narrative on the upside this morning. You got Tesla up 1/3%. This is what the Wall Street scribes are writing about this morning. Goldman Sachs upgrades Molson Coors to a buy, expecting the beer maker to outperform given historic seasonal trends. Barclays downgrades American Express to equal weight, warning of limited upside due to slowing revenue growth. And finally, you've got JP Morgan upgrading American Eagle to overweight. What they're pointing to is conservative sales estimates, and recent growth initiatives should underpin the stock. Coming up, Schwab's Ann Sonders joins me to make the case for extended bouts of volatility. Get ready for that. She reveals her outlook. That's next. And the opening bell is up. Okay, so we've got bond yields incrementally lower. Is that enough to give you a bid in some of these markets? Stocks are up in the Nasdaq, up 0.5%. A little bit of cheer. We're counting down to CPI, and that is going to define perhaps where the next bond yield move goes, and so therefore risk, which takes us to the 10-year yield, as I say, a couple of basis points lower, but hardly what you call significantly lower. We are one hot CPI print away from a dereliction of the bulls in this bond market. Dollar yen flat at the moment, but of course we've had utterances from not just the finance minister about watching the developments in the FX market, and the Bank of Japan governor talking about the lack of desirability in FX moves, unched in oil. We gave a little bit back yesterday, nearly 1% down. Goldman Sachs are talking about the risk of $100 oil, as well as that Vitol also talking about oil in the range $80 to $100 on the upside. But we're back to stocks. You remember BlackBerry used to have one of those. The software company announcing robotics collaboration with AMD. Rejuvenation from a bygone era. Abby.
A rejuvenation indeed, and the stock is responding well, up 8.3% at this point. It had been on pace for the best day in about 2 weeks. Now the best day in about a month, so investors are liking this, and it is interesting that BlackBerry still is around, a security software company, and their description also includes AI, so I'm curious to see whether or not we'll be hearing more and more about BlackBerry as time goes on. But to your point, they have announced this collaboration with AMD right now, so that's a good connection right there. They, of course, the hot chip company, but also with the AI connection. And they're focused on the robotics industry to provide real-time performance, precision, reliability, and scalability. The company is saying that the combination enables sensor fusion, high-performance data processing, real-time control, industrial networking, and reduced latency in robotic applications. I'm so excited about what all of this will mean in the future. Can't even get my words out. As for the stock and growth, that is probably what they're trying to juice. Growth is somewhat flat for BlackBerry. The stock over the last year, Manus, into today, down more than 36%, but eating into that a little bit. And there is, of course, an 8% short interest. So some of this is probably a squeeze.
Okay, Abby, thank you very much. Let's turn our attention to the cannabis industry. Tilray falling, I should say, after cutting their full-year guidance, as well as missing the third quarter revenue. Alex Semenova is with me on the numbers, down 14% and change on Tilray.
Good morning, Manus. That disappointing guidance, that revenue miss were among the woes in Tilray's earnings that sent shares down as much as 19% this morning into the open. That is the biggest decline since May 2023. The company reported revenue for the fiscal third quarter that failed to meet estimates. It also cut its full-year adjusted EBITDA outlook below analyst expectations. Tilray now sees adjusted EBITDA from 60 to 63 million. That's well below the 68 to 78 million the company previously saw. Revenue did rise 29% to 188.34 million from the year-ago quarter, increasing both in its beverage alcohol business and in its cannabis business, but it fell short of analysts, the 198.3 million analysts had expected. Additionally, the company said that it no longer expects to generate positive adjusted free cash flow for the full fiscal year due to delayed timing to collect cash on various asset sales. Tilray said that its U.S. cannabis strategy is, quote, in place to strike if the U.S. reforms drug policy. The stock was up around 13% year to date through yesterday's close, as the Biden administration has shown signs of support for marijuana reforms. Manus.
Okay, thank you very much, Alex. I'm over there. Now, it's two different stories for two different banks. Wells Fargo downgraded by Compass Point, while First Horizon receives an upgrade on the bank's trajectory. Simone Foxman has the latest. So where do we fall on this?
Yeah, Manus, analysts staking their claim here ahead of earnings season for banks, which kicks off on Friday. We've talked a lot about JP Morgan, Citi, but Wells Fargo also reports that day. It's currently flirting with its highest level since early 2022 and up about 17% year to date. But Compass Point analyst David Rochester, he's just downgraded Wells Fargo to neutral from buy. He says although he sees a bunch of key potential positives this year, including regulatory wins, stronger buyback activity, and higher for longer rates would help Wells Fargo, he says the valuation is already baked in, but he keeps his price target of $64 a share, a little higher than we're trading right now. On the regionals, though, a lot of attention is going to be focused there because remember what was happening last year, the collapse of Silicon Valley Bank, and there are tough comparables, but the picture has brightened, and that is the case for First Horizon. It's among the better performing regional banks, up 7% year to date after falling 42% last year. RBC analyst John Arfstrom is upgrading that stock to outperform on increased confidence in near to medium term trajectory. He thinks we'll get to $18 a share as net interest income and fee revenue improve. Lower rates also would help First Horizon. We shall see. Get some verdicts starting on Friday, Manus.
Yeah, well, a year ago we convulsed over some of those regional banks, didn't we, Simone? And then there were the calls for recession, which we've escaped. Simone Foxman, the very latest on the banks. Turning our attention to funds. The Destiny Tech 100, a closed-end fund, has surged over 9 times its value in just a couple of days. Who better to tell us this story? Why? It is Katie Greifeld. Katie.
Manus, this is a really fun one. Like you said, this is a publicly traded closed-end fund that invests in private tech companies. Its target portfolio is 100 companies, but currently it only holds about 23 companies, with its top holding being SpaceX, of course, Elon Musk's rocket company. That currently has a 34.6% weighting in the portfolio, and it's followed by the likes of Axiom Space, Boom Supersonic, and Epic Games. Now, that's already fun, but the really fun part is watching the stock. It began trading in late March. It's up literally 1,000% since then, even with the drawdown today. It currently has a market cap of about $1 billion. And that raises some really interesting questions for Destiny. So it computes its net asset value quarterly. Its most recent calculation lists the net asset value per share at about $4.84. But as you can see, currently shares are trading above $80. So we're talking about a huge premium there. It's going to be really fascinating to see how this story develops.
It's like a moonshot stock, but it sounds pretty cool. Katie, thank you very much. Katie Greifeld there. So the bond market is in a mini recovery mode as we count down to the CPI. Keith Lerner of Truist writes this. Market participation broadened significantly with the economically sensitive sectors such as industrials and financials making all-time highs alongside the mid-caps and the S&P Equal Weight Index. And that was the first 3 months of the year. Joining me now is Ann Sonders, my guest this morning. So we've had this broadening in the markets. It's been a theme that we've touched on quite a bit. How significant has the participation been in that breadth in the markets? Ann, good morning.
Good morning. It has improved. One way to think about that, not in traditional breadth terms of things like moving averages, but over the past year, only 11% of the constituents of the S&P have outperformed the index itself. But over the past month, that's closer to 50%. So it still probably could be and should be higher, but that's a significant improvement as you think about the concentration that was so evident last year and much broader participation, not to mention the shift in leadership away from many of those mega cap techie kind of names to more traditional cyclicals like energy and financials and materials.
Are we at the beginning of something much more significant? I'm looking at some of the news flow from the FT conference. VTOL, Russell Hardy talking about $80 to $100 in oil and a shift in the commodity cycle. Goldman's talking about the risk of $100 oil, and I've got Bank of America banging into the inbox this morning with gold at $3,000. How do you look at commodities? How do you participate in obviously what is some kind of a shift for a whole variety of reasons in commodities?
Yeah, I think the fundamentals behind it, aside from things like, momentum just feeds on itself and you generate enthusiasm, certainly on the part of retail investors. But I also think it may reflect some sign of improvement in the global growth outlook. There's obviously also the supply-demand fundamentals, especially as it relates to oil with production cuts in the case of Russia. And so I think it's just a story that has been to the benefit of not just commodities, but traditional equity sectors like materials, which is a play on that. Now, it's also been a boost to headline inflation metrics, including headline CPI, that obviously could continue to be a feeder. And even though core is ex food and energy, if you look at the relationship historically between even whether it's core CPI or core PCE, and then the commodity complex, there is a feeder there. There's both an actual feeder and a psychological feeder. So that's something to be mindful of, especially a day ahead of tomorrow's important CPI report.
And we're counting down to that CPI report. The bond market takes a breath this morning, doesn't it? But it's been a pretty ferocious run up in this bond market over the past 6 trading sessions. How concerned are you that this CPI could be a significant dislocator? I mean, we're looking for a drop on the core to 0.3%, but we're still looking at quite a chunky year-on-year figure.
I think for both CPI and PPI, yes, I think they could be market moving, especially if they're outside the range of consensus. But what I think is important now is how the readings, the combination of CPI and PPI, map to PCE, because that is the Fed's focus. PCE has been running lower, both at the headline level and the core level, to the tune of about 80 basis points or so. So I think the real calculus is about economists taking a look at the combination of CPI and PPI and figuring out how that feeds into the next PCE report, not just at the headline and core level, but also core services ex housing, which has been that specific metric that the Fed has focused on.
Do you think clients have a temptation at these kind of yields, these kind of headline yields, I should say, rather than yield to maturity in bonds? Is there a certain amount of temptation to step in and pick up coupon and duration?
Well, we've actually, and my colleague Kathy Jones is our fixed income strategist. You have her on your air quite a bit, and have encouraged lengthening duration so that you are locking in these higher yields, even if they look still slightly less attractive relative to much shorter duration yields. You don't have that rollover risk. So there is a benefit to locking in that longer duration, but obviously decisions as it relates to where to be on the duration spectrum is very individual specific, depending on your needs for income and time horizon, et cetera.
Now, in part of the narrative that you put out there, you look at the revisions to GDP and you normally say, look, normally you don't have to pay too much attention to that. And I like the line which was au contraire, and you talk about the upward revision in the personal spending space. And that suggests the consumer still remains strong, still remains robust. What does that mean from an equity perspective?
Well, yeah, the consumer has been a big driver of the economy and very robust. And that sort of flies in the face of what traditional fundamentals around things like the savings rate might suggest. But what I think it's driven by is the strength in the labor market, both in actual terms and psychological terms, but also, the net worth gains, which, obviously it leans more toward the upper income end of the spectrum. But since last October, we've had about $13 trillion of net worth added to U.S. individuals. And to put that in the context of consumer spending is about $19 trillion. So that's a huge increase. But we are starting to see shifts as it relates to inflation and the hits. And, I think you have to now focus on not just nominal data, but real data and shifts in terms of the preferences on the part of individuals, what's happening down the income spectrum, and increased use of credit cards and delinquencies picking up there. And that to some degree has been reflected in how equities have behaved too, is that sort of fine-tooth comb analysis that is necessary to see what's really going on under the surface of things like headline reports and index gains.
Yeah, well, it is that differential, isn't it, between the sort of the upper income levels perhaps and the lower income levels having a tougher time, and then we have the small businesses confidence they're coming in at an 11-year low. So it is the nuances. Liz Ann, thank you very much. Liz Ann Sonders of Charles Schwab, my guest this morning on the equity markets. Coming up, Boeing delivery, despite its troubles, can they?
Without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing. We've got to get Boeing back to the point where it produces an impeccable product.
The conversation next on Bloomberg.
You're looking at Airbus and Boeing as to purchasing airplanes. What you try to do is you try to find the best quality, the best price, the best operating costs. Without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing. We've got to get Boeing back to the point where it produces an impeccable product.
Well, Boeing and Airbus both set to post their first quarter deliveries a little bit later today, and the analysts are anticipating to see cash woes from Boeing. Joining me now is our Boston Bureau Chief, Brooke Sutherland, on this story, and she also writes for Bloomberg's Industrial Strength newsletter. Brooke, how much of a crunch will the production slowdown be at Boeing? What's the scale of the production slowdown, first of all?
I think it's going to be pretty substantial. So what the FAA has done is it's capped Boeing's production rate at 38 a month, but they are not producing anywhere near that level. And I think, you're going to start to see the impact in the coming months of Boeing's effort to move away from traveled work. So what that means is in the past, they'd really put a priority on keeping those airplanes moving down the production line and keeping those gears of the factory turning. Instead, they're going to stop that, really focus on making sure that the plane has all of the parts it needs and quality is where it needs to be before it moves on to that next step. But of course, in the interim, that does weigh on deliveries.
And in terms of when the FAA take the cap off, remove the cap, just give me a sense of how quickly they can retain or re-ascertain those production levels. Because at the moment, they've got to go for quality, real quality, relative to where they were. And that ultimately has a cost.
I don't think the FAA is in any rush to lift that cap. And so what they've said is that that cap is in place until they feel satisfied with Boeing's quality control procedures. Now, they separately did an audit of Boeing's production lines, cited multiple instances of manufacturing lapses. So I think there's a lot of work that needs to be done on the Boeing factory floor before the FAA feels comfortable to even talk about moving away from that cap on the production rate. But to your point, absolutely. I mean, I don't think that this is, once the FAA does give Boeing the green light, they can just snap their fingers fingers and start producing planes at a higher rate. Like I said, they're not anywhere near close to that cap right now because they are focusing on safety, but you also still do have supply chain issues in aerospace. This is the one corner of the economy where we are still seeing parts shortages, labor shortages, a whole series of different factors that are impacting companies' ability to produce the parts that they're supposed to. And this is not just a Boeing problem. GE has talked about 80% of its delivery challenges are rooted in its supply chain. So this is across the whole aerospace and defense ecosystem. And that also is a gating factor in terms of how many airplanes both Boeing and Airbus can ultimately produce.
Now, look, it's been a couple of weeks since Boeing announced Calhoun was going to go at the end of the year. This is a company essentially in strategic limbo. And I just want to get a sense of to what extent that holds this company back from delivering on the requirements of the FAA and then getting back to some kind of uplifted quality norm.
I don't think it's helpful to have this period of limbo, to your point, but I also think that they don't have the right candidate yet signed up to replace Calhoun. So on the one hand, you would want them to find that person, and introducing another figure right now is just going to add to the uncertainty. So I do think, Boeing has every reason, and I think they are finally taking this seriously, to get to the bottom of their quality control issues and make sure that they can reassure their customers that they can actually deliver the planes that they have promised. And so I think they have every incentive to figure this out, no matter who is in the CEO role. But there is, they do need to take the time to get this right. They need somebody in that job who is going to actually solve the problems, because Calhoun was brought in to solve a crisis when the two 737 MAX jets had crashed. And Boeing is still dealing with many of the same problems. And so I think if you're an investor or a Boeing customer, you want them to really take the time to find the right person to lead this company into the future.
Brooke, thank you very much. That's Brooke Sutherland. We'll wait for those numbers from Boeing. We'll bring those to you as soon as they cross the Bloomberg terminal. Sector price action for you this morning. Abby's with me.
Well, Manus, we're looking at a very small gain for the S&P 500 right now, up about 0.1%. Now, interestingly, it is a broad-based gain, lots of sectors higher, but not up by much, and that is basically why it's such a small gain. Up top, real estate up 0.5%, despite the fact that you have yields down, which would typically, actually, that does make sense in terms of dividends of real estate looking more attractive. Plus, yesterday's big deal, $10 billion deal, Blackstone buying that apartment REIT to the downside, financials, industrials, consumer staples. Now, what's interesting, though, we may have financials down 0.3% ahead of the big banks reporting on Friday, Manus. However, or some of the big banks, I should say, the regional banking index, that ETF, and in this case, index, up 1.8% over the last 2 days. So some of those small cap banks getting a bit of a bid.
Okay, Abby, thank you very much. Coming up in the show, market moving events to set your watch by. It is your trading diary on Bloomberg. Basis points down on bonds, really enough to give succor to the equity market? Well, if that's the narrative you want to play out, please do. You've got stocks holding on to their gains. This is ahead of the CPI. We're expecting 0.3% of a number on the core. We've got 24 hours to run, less than 24 hours to run on that. Right now, there's a resilience in stocks. Your trading diary looks a little bit like this. Treasury auction is coming. $58 billion of 3-year notes at 1 p.m. Eastern. Wednesday, it's another big day for CPI. The report in America, as I say, will come out. And you have PPI and initial jobless claims hitting the tape on Thursday. Follow through, you'll have an ECB decision, and that differential between the ECB and the Fed is going to become ever more apparent. Mohamed El-Erian's discussion on surveillance this morning is relevant on that. Bank earnings hit the tape on Friday. JP Morgan, Wells Fargo, and Citi all deliver their results. We're counting down to these auctions at the short end and indeed longer dated paper as we go through on the week. Threes today, $39 billion of 10s tomorrow, and $22 billion of 30-year paper coming through on Thursday. That was countdown to the open. We're nervous ahead of CPI. This is Bloomberg.